If you are brave enough to look at your portfolio this morning, or even if you're just doom scrolling the headlines, you might want to find a very comfortable chair first.
Maybe pour a strong coffee.
A very strong coffee. We're recording this on Wednesday, January 21st, 2026, and to say the dust hasn't settled, I mean, that would be the understatement of the decade.
It really would. We're coming off what future economic historians might actually circle on the calendar as a genuine pivot point.
Yeah.
Yesterday, Tuesday the 20th, was the first trading day after the Martin Luther King Jr. holiday, and it felt like the entire post-war economic order just fractured.
It was absolute chaos. You look at the scoreboard. Yeah. The Dow Jones plunged 877 points. S&P 500 down over 2%. But the sentiment, it wasn't the usual sector rotation.
Yeah.
You know, usually it's sell tech to buy staples or something like that. This was different. The traders were describing it as sell America.
That is the phrase that really sticks out to me, sell America, because usually when the world gets scary, a war, a pandemic, uncertainty, money flows into the U.S. dollar.
Right.
This safe haven.
It flows into U.S. treasuries.
Yeah.
It's the global safe haven. Yesterday we saw the exact opposite. And that's because the source of the scare isn't external. It's internal. It's institutional.
And that is our mission for this deep dive. We have a massive stack of sources here: PBS News, Market Minute, FX Empire, some very dense corporate press releases.
Yeah.
We need to connect three things that sound totally unrelated.
Okay.
A building renovation in D.C., an island in the Arctic, and a cold weather forecast.
It sounds like a random collection of events, almost like a conspiracy theory board, but they are all stitched together by one single theme: institutional instability.
The guardrails we rely on are, well, they're buckling.
So let's unpack this. We have to start with the biggest domestic story, the Federal Reserve, or I should say the Department of Justice versus the Federal Reserve. This feels like we've crossed a line.
We have. This is the constitutional crisis component of the storm, to get everyone up to speed. On Sunday, January 11th, grand jury subpoenas were served to the Fed, but the fallout really peaked yesterday. The Department of Justice, led by Attorney General Pam Bondi, has officially launched a criminal investigation into Federal Reserve Chair Jerome Powell.
Okay, so for anyone listening who just sees the headline Fed investigation and thinks, this is about interest rates.
Right.
What is the actual legal charge here? I mean, they're not indicting him for keeping rates high. That's not a crime, right?
Officially, no, not a crime. Officially, this is about construction.
Construction.
The charge being floated is misinformation regarding the renovation of the Mariner S. Eccles building. That's the Fed's headquarters. It's a massive project, roughly $2.5 billion. The investigation is scrutinizing alleged cost overruns and what some sources are calling lavish features.
Lavish features? I saw mentions in the reports of, rooftop gardens and VIP dining areas.
Exactly. So on paper, the most powerful economic figure in the world is being subpoenaed over, landscaping choices.
Which brings us to the subtext. Because I don't think the Dow dropped nearly 900 points because traders are worried about the Fed's gardening bill.
Right. This is what legal analysts in our source material are calling pretextual. The widespread belief, and certainly the defense from Powell's camp, is that the building is just an excuse.
It's the lever.
It's the lever to apply pressure. The real issue is that the president wants interest rates cut to 1%, and Powell and the FOMC have refused, citing, stubborn inflation.
So Powell released a video statement, which is in itself bizarre. Usually with a dry PDF from the Fed, a video feels combative.
It was unprecedented. He called the investigation political intimidation. He essentially looked into the camera and said, "I will not be bullied into cutting rates." He's drawing a hard line.
But he's not alone on that line, is he? The reaction from the old guard of economics was immediate.
It was heavy. You had a bipartisan letter signed by 13 former Fed and Treasury officials. We're talking Bernanke, Yellen, Alan Greenspan. These are people who rarely agree on anything. They've spent careers arguing with each other. But they agreed on this. They didn't mince words. They said this kind of behavior belongs in emerging markets, not the United States.
That phrase, emerging markets, is doing a lot of work there. They're basically saying this is what happens in a banana republic.
Precisely. The logic is simple. If the person in charge of the money supply can be threatened with jail time if he doesn't print more money, well, then the money becomes worthless. Trust just evaporates. That's the fear.
But politically, this isn't a clean split. It's not just one party versus the other. It seems like the GOP in the Senate is actually fracturing over this.
That's a crucial detail. You have Senator Tom Tillis and Senator Lisa Murkowski publicly defending Powell, Tillis even threatened to block any new Fed nominees.
So he's grinding the confirmation process to a halt.
To a halt. But then on the other side, you have Representative Anna Paulina Luna cheering it on, saying the probe is a result of her criminal referral. She sees the Fed as this corrupt institution.
So it's a civil war within the government about who controls the economic levers.
Yeah.
And the market looks at this and just says,
The Fed put is dead.
we should probably explain that. The Fed put.
Yeah.
Historically, investors believed that if the market crashed, the Fed would step in, lower rates, buy bonds, save the day. It's a safety net. But if the Fed is fighting for its own legal survival...
Exactly. They can't save the market. They're too busy hiring defense attorneys. That safety net is gone. It's been replaced by Fed friction. And now there's this shadow chairmanship theory gaining traction.
Oh, I read about this. It's like high-stakes 4D chess. Walk us through it.
Okay, so Powell's term as chair ends in May. Usually the outgoing chair just leaves. It's a courtesy.
Right.
But his term as a regular governor on the board doesn't expire until 2028.
So he could step down as the boss, but stay in the building?
Yes. And the speculation is that he might do exactly that, stay on as a governor just to block the president's next pick, act as a firewall. He'd be a shadow leader from a junior seat.
That would be an incredibly awkward boardroom.
Dysfunction defined. And frankly, with the Supreme Court hearing arguments today about the attempt to fire another governor, Lisa Cook, the whole board is under siege. It's not just Powell.
Okay, so that's the domestic pillar. The institutions that manage our money are at war with the DOJ. Now we have to pivot to the map. Because if you thought the D.C. drama was loud, the situation in the North Atlantic is deafening.
This brings us to the Greenland mandate.
I have to be honest. If you told me 5 years ago that a major trade war would start over Greenland, I would have laughed. I would have thought it was a joke. But here we are.
It's a severe ultimatum, and it's moving very fast. The U.S. wants to acquire Greenland. The administration is frustrated by the refusal, so they've threatened a 10% tariff on 8 NATO members.
8 of them.
And it starts in February, rising to 25% by June if a deal isn't reached.
We need to be specific about who's being targeted. This isn't just Denmark.
No, it's a coalition. The tariffs target Denmark, obviously, but also Norway, Sweden, France, Germany, the UK, the Netherlands, and Finland.
Wait, France and the UK. We're threatening a trade war with our closest nuclear allies because Denmark won't sell an island.
In simple terms, yes. And that's why the term fracture is being used. This isn't about steel subsidies. This is about territorial acquisition. And the reaction has been visceral. Denmark has actually deployed troops.
Troops?
To Greenland. Operation Arctic Endurance, they're calling it, to assert sovereignty.
That's kinetic. Troops moving is a lot different than ambassadors writing angry letters.
It is. European leaders are warning of a downward spiral. It moves us from a world of allies to a world of transactions. It implies even security guarantees are now up for negotiation.
It feels like the end of the special relationship with the UK.
It essentially is, and for businesses, this is a nightmare. The CEO of 3M, William Brown, came out warning about earnings hits. Supply chains are so integrated, you can't just slap a tax on Germany without causing chaos for American companies.
So if I'm a global investor, I'm looking at the U.S. government subpoenaing its own central bank and simultaneously starting a trade war with NATO.
Exactly. And you ask yourself, is the U.S. dollar still the safest place to be? And yesterday, the answer was a resounding no.
Which brings us back to the markets. The 10-year Treasury yield spiked past 4.2%.
Bondholders are demanding a higher return to hold U.S. debt because it's suddenly riskier.
And the dollar weakened against the pound, the euro, the yen. But the real story, the real fear gauge, was gold.
Gold went parabolic, hit a record high of over $4,700 an ounce.
$4,700. Just think about that. A few years ago, $2,000 felt like a ceiling.
This is what analysts call a political risk premium. Gold is the hedge against the system breaking. When the dollar looks unstable, you don't buy paper, you buy hard assets.
Speaking of hard assets and going parabolic,
Yeah.
we have to talk about natural gas. This might be the craziest chart of the week. Prices spiked over 20% overnight.
This is the third pillar of our perfect storm. You have the institutional crisis, the geopolitical shock, and now a market structure explosion. Natural gas trading around $4.86, a 20+% move in one session, is violent.
Why did it happen? Was it just the cold weather?
It was a combination of weather and what we call a short squeeze. See, back in November, traders held record short positions.
They were betting prices would go down.
Heavily. They looked at the long-range forecasts, saw a mild winter, and piled into the sell side. They were complacent.
And then the forecast changed.
Drastically. A shift in the models over the weekend showed a massive Arctic blast coming in 10 to 15 days. Suddenly, all these traders who bet on mild weather realize they're on the wrong side.
And when everyone rushes for the exit at the same time,
The price explodes. But there's a physical reality here, too, that makes it worse. The market is terrified of freeze-offs.
freeze-offs. That sounds like a horror movie title. What is that exactly?
It's when the extreme cold actually freezes the liquids inside the pipes at the wellhead. So precisely when demand is peaking, the physical machinery freezes and supply gets cut off.
So you have a supply crunch, a demand spike, and a financial panic all at once.
Exactly. It's a perfect microcosm of the broader chaos. Unpredictable variables compounding each other. It's Murphy's Law applied to the commodities market.
It makes you wonder how actual companies are navigating this. Because while governments are fighting, corporations still have to make payroll.
They can't stop. But their strategies are shifting. We're seeing a move toward extreme defensiveness, consolidation, certainty. Look at the news from Netflix and Warner Bros. Discovery.
Right, they amended their merger agreement. What changed?
The key detail is the structure. It is now an all-cash transaction, $27.75 a share.
Why does all cash matter so much right now?
Because in a market this volatile, stock is a shaky currency. If you're a Warner Bros. Shareholder, do you want shares in a new company that might tank next week?
No, you want cash.
You want cash. Cash offers certainty. It signals that companies know their own stock isn't a stable currency anymore.
And it seems like owning real things is another theme. Verizon just closed their deal with Frontier yesterday.
Yes, Verizon picked up 30 million fiber passings across 31 states. It's a massive bet on hard infrastructure. Owning the actual fiber in the ground, the coal road for the internet, is seen as a defensive moat.
There was an interesting regulatory nugget in that deal, too, with California.
True. To get the deal done, California regulators require them to provide free broadband to low-income families for 10 years. So even amidst the chaos, the regulatory state is still extracting its pound of flesh.
Speaking of infrastructure constraints, we have to mention the AI power crunch. We've talked about AI a lot, but usually the software. Now it's about electricity.
This is becoming the hard ceiling for the AI boom. The PJM grid operator, which manages power for a huge chunk of the eastern U.S., they're basically telling tech companies, we can't plug you in.
Literally.
Literally. They're saying if you want to build a new AI data center, you need to bring your own power plant. The grid cannot handle the spike in demand.
That is a wild shift. It's not just buy a server rack. It's build a natural gas plant to run your server rack.
It's another layer of friction. The AI growth story is colliding with the physical reality of the power grid. And again, it reinforces this theme of hard assets. Code isn't enough.
So let's try to synthesize this for the listener, because we've covered a lot of ground. The Fed fighting the DOJ, Europe mobilizing troops over Greenland, commodities going haywire, and corporations hunkering down.
It's a synthesis of instability. I think the big takeaway is we are witnessing a shift from a rules-based order to a transactional world.
What do you mean by that distinction?
In a rules-based order, you know the Fed is independent. You know NATO is a defensive alliance. You know the rules of the game. In a transactional world, everything is up for negotiation every single day. The rules can change because of a subpoena or a tweet. Everything is volatile.
And for the listener, that means the safe bets aren't behaving safely.
Exactly. If you're holding treasuries, they're wobbling. If you're holding dollars, they're weakening.
Yeah.
The political risk premium is real. You can't just look at the CPI report anymore. You have to look at legal filings from the Department of Justice.
That is a scary thought. That a subpoena is a more important economic indicator than inflation data.
But that's the reality of January 2026.
Before we wrap up, I want to leave everyone with a thought. We mentioned Powell potentially staying on until 2028 just to block a successor. We mentioned Europe mobilizing troops.
It raises a provocative question. Are we seeing the end of economics driving markets? For the last 40 years, markets moved based on earnings and interest rates. But if the Fed becomes an active player in a political power struggle...
What happens to the game?
Right. If the referee starts tackling the players, the score doesn't matter as much.
And if you're an investor, you have to ask yourself, is my portfolio built for a game of economics, or is it built for a game of power? Because those are two very different strategies.
Something to mull over as you watch the tickers today.
Thanks for joining us on the Deep Dive. We'll be keeping a close eye on the Eccles building and the weather forecast.
Stay warm, everyone.
See you next time.